Good morning and welcome to the CFRA webinar. I'm Ken Leon, Director of Equity Research at CFRA, and we're delighted to be with you today to present Down But Not Out, Investing in Distressed Industries. You know, it's an opportune time really to kick the tires and get our best analysts to really do a deeper dive on industries and stocks that perhaps have not fully recovered or going back to pre-pandemic, or will they, or is there going to be a new normal? And certainly the industries and companies that we will be talking about still have opportunity, but they also have risk. Next slide. So with me today are Colin Scarola, Vice President Equity Research, and Tuna Amobi, also Vice President and Equity Research Analyst. Both of them are really going to be sharing with you some great insights on industries investors are still not sure what the future will look like. Next. Before we do that, for those who are new to our webinars and others, a little bit about CFRA. So CFRA is world-class, one of the largest independent research firms. Our firm is 100% focused, invested in fundamental research, whether it be our equity research team or forensic accounting. Our ability to really cover breadth, but also depth and quality really makes CFRA stand out. We offer to our customers either on Market Scope Advisor or in direct feeds, a market commentary, sector watch. Many of you are getting that from Sam Stovall, our Chief Investment Strategist. ETF and mutual fund research headed up by Todd Rosenbluth. And then our team, our large team that is covering industries and sectors and companies, 1,500 global companies on a stars basis where analysts make decisions, along with a larger base of 25,000 plus global companies on a quant basis. Our customers also have access to our portfolios, model portfolios, and what we think we're exceptional and lead the market is the ability to uncover idea generation, which we show in our thematic research and our other research products, but then also our equity analysts collaborating with our forensic analysts are able to do risk mitigation. Next slide, please. So I mentioned we're 100% focused and invested in fundamental research. We are truly an independent investment research firm. We really do not have an investment banking broker dealer or an asset management arm, which means we're here to serve you. This may be claimed by some of our direct competitors, but it may not be true. Next. So moving to our agenda today for the webinar, Tuna is going to kick it off with the 2021 economic outlook. Colin will give you kind of the template of how we think about distressed industries and opportunities. And then both of them will do the deep dive, as you could see here, on industries from hotels and resorts, casinos and gaming, airlines, and commercial aerospace. So I'm really excited for this webinar. Good morning, Tuna. Why don't you go kick it off?
Great. Thank you so much, Ken. And I am just as excited as you are. And good morning, everyone. And we are very thrilled that you can join us today. So as Ken just alluded to, I am going to start my section of the presentation with kind of a quick macro backdrop. So next slide, please. So we figure that we kind of give a kind of a concise view of the some of the key macroeconomic indicators that affect the some of the industries that we'll be talking about today. And this slide actually shows you, you know, what the state of affairs is in regards to real GDP growth as well as consumer spending. coming out of the COVID-19 recession. And as you can see clearly, both on the quarterly and annual indicators, both metrics are actually showing green shoots out of the coming out of the COVID-19 recession, which precipitated a major decline in both in the GDP and consumer spending. As some of you know, consumer spending is actually far the bulk of the GDP. What this shows is that the outlook is, the horizon is looking much better, both through the rest of this year and going forward into 2023, where you'll see these trends both start to revert to normalized levels. And I might add that some of the reasons that that's happening is that you're starting to see a steadily declining rate of COVID-19 infections, this year after the surge we saw last fall. So these declines are going faster than expected pace. And also stimulus checks from the COVID-19 relief bill are starting to hit the consumer pockets. All of those are good signs as to why consumer spending and GDP should be looking up from here on out. Next slide, please. On this, we're showing you the travel and tourism value added, which again gives you some context as to the contributions of travel and tourism to the overall US GDP. And you'll see that trend over the last decade has more or less increased and more recently, has stabilized. So it is something to remember when talking about, importance of travel and tourism to the overall US macroeconomic outlook. Next slide, please. And here we're looking at travel spending in the US and how that kind of has shaped out before and after the COVID-19. And what's pretty clear here is that COVID-19 actually had a very deleterious impact on the total travel spend in the US, which you see that major decline, but now poised for what seems like a V-shaped recovery this year and more or less stabilizing thereafter. So remember that one of the indicators that affects the travel spending is the composition of international visitors in the US, which in 2020, international visitation is not shown on this chart, but plummeted actually north of 75% last year, and now it's projected to rebound, over 74%, this year. So a lot of tourism travel spend in the U.S., attributable to international visitation, which is also projected to recover and contribute to the improved outlook that you see here for overall travel spend in the U.S. Next slide, please. So figure here is the jobs and employment picture. This slide shows you kind of, how the unemployment rate for various industries look before and after the pandemic. And within this leisure and hospitality, which, by the way, these are the the Labor Department official classification of the industries. And within our context, we'll focus on the top three, which are the accommodation, the arts, entertainment, food services, etc. These are like the constituents of the leisure and hospitality, and all of the what we're talking about today will relate to this. So what's pretty clear, if you look at the orange bars, is showing you the unemployment rate post-pandemic as of January 21st, and the navy blue bars show you the January 20 year ago, before the onset of the pandemic. And you'll see that the top three sub-industry constituents pretty much, have the, largest, discrepancy in terms of the rate before and after, which suggests to us that those are going to be facing the steepest uphill climb coming back from this jobless recovery. I might also add, if you listen to Jay Powell's congressional testimony yesterday, it sounds to us that the official rates that are being reported here are actually much lower than what Jay Powell is talking about, the real unemployment rate being, almost 4 percentage points higher than the official rate. So leads us to believe that even the rates indicated here could be very well understating the real unemployment rates for this leisure and hospitality in the onset of COVID-19, which suggests to us that the road back to recovery could be much more dire than expected, and perhaps why some economists are saying it could take more than 2 years to recoup all of the job losses that have occurred as a result of this COVID-19. Next slide, please. And here we'll show you the remote workforce by business sectors. One of the things that's obvious here to you, or should be obvious, is the fact that the leisure and hospitality, in terms of the share of US workers that can telework, actually way below the average of about 46%. What that means is that the that sector has been pretty much negatively impacted by the lockdown, and will probably take longer. Again, supporting the prior view that it could take much longer for that space. And as a corollary here, you'll notice that the financial activities and the white collar occupations, more or less, are the ones that have the higher percentage of workers who can telework, as I'm sure a lot of you on this call can relate to. So again, supporting the overall picture that some of the distressed names that we'll be talking about here, actually have a much steeper climb. And that's why sometimes you hear about the bifurcation in COVID-19 lockdown impact on the overall economy. And some have talked about a tale of two economies, whereby the white collar occupations are actually faring much better, whereas the other side are actually facing much steeper challenges. So at this point, I want to pass it on to my colleague, Colin, who will provide you a framework for our identification of the distressed industry opportunities. Again, this is something that helps us to set the scope of this webinar in terms of the sub-industries that we'll be focusing on. So Colin, please take it away.
Thank you, Tuna, and hello to everyone who's on the line today. Thanks for joining us. So on the next slide here, I'm gonna show you the industries that we've identified as distressed. And these are industries where you really have one of two things going on. Revenues down sharply last year, the pandemic year, versus 2019. And in a lot of stocks within these industries, where the market cap is down severely versus the pre-pandemic high. So this is true of a lot of industries that involve social gathering. I'm sure that's not surprising to most of you. So hotels, resorts, market cap down 16% in February of this year versus the start of 2020. Airlines down sharply, aerospace and defense down sharply. That's where commercial aircraft manufacturers and their suppliers reside, in addition to some defense contractors. So we'll dig into these industries more throughout the presentation, but we just wanted to kind of lay out which ones we've identified here as distressed and where we're going to be looking for opportunities. So next slide, please. So now we want to talk about why we think there might be an opportunity to buy these while they're still down so much. So a big reason is the current state of the U.S. consumer, based on a lot of federal stimulus and having to stay at home a lot during the pandemic, not being able to spend quite as much. We've got significantly elevated levels of disposable income and personal savings. And next slide, please. So what's been going on that we've seen is, with more disposable income, consumers have been spending pretty heavily, but it's been mostly on retail, and in particular, durable goods spending. This chart on the lower right, you can see it's still up. As of the end of 2020, it was up 11% year over year. So whether it's the stimulus checks and not spending as much on gas to get to work maybe, or you're not taking vacations, you've got more money and you're saving more. But you've also spent a lot on things around your house, maybe home furnishings or redoing an office space, or you bought a new TV or a new car, whatever it might be. Durable goods spending's been up. So where does that leave us? Let's go to the next slide, please. So we think the next wave of consumer spending is going to be on vacations and travel type things. And the reason for that is we know that consumers still have elevated disposable income and savings, but we also know they've already spent a lot on big ticket durable goods items. So putting those purchases behind them, they're probably going to be looking to spend on trips. That just makes a lot of sense to us. And we can see air travel is still significantly depressed, still at less than half of where it was before the pandemic. And road travel is also down, still about 20%. So we think as COVID cases decline, we're going to see restrictions ease, and people are really going to start releasing pent-up demand to get out on the road or get to the airport and go take some fun trips. So that's why we think there's an opportunity in these industries that are still currently distressed that involve social gathering. So with that, I will hand it back over to Tuna, and he will dig into two industries he covers here.
Great. Thanks a lot, Colin. So I'm gonna, next slide, please. I will be digging into some of the industries we cover, but first I kind of figured this sector outlook heat map kind of gives you a bird's eye view of how the COVID-19 has impacted various constituents of the global leisure and hospitality space, and also what the outlook for recovery is. And this is really where it starts to get very interesting, because one thing that's pretty clear right away here is that when it comes to the impact of COVID-19 across all these various constituents, they are not all created equal, right? So if you look at the the various categories, you see casinos and gaming and hotels and resorts, out of home entertainment, which includes things like concerts and sports events, live things of that nature. And then in-home, which would include television, streaming, etc. And then the restaurants, you'll see various categories, and they're all being impacted to various degrees. If you look at the fourth column, shows you impact if COVID-19 vaccine is delayed. At this point, we know that the vaccines are out, but there are still uncertainties as to potential timing for widespread availability of those vaccines, which our base case is that it will happen by H2. But now we're talking about different variants, etc., of the virus. So there's still some moving parts out there, which we factor into our analysis here. Pretty much you'll see that in general the most adversely impacted sub-industries here are those that entail outdoor gathering or live events, or mass kind of massing of people, and in general those that are more favorably impacted are those that involve in-home activities or less social gathering. And that's also pretty evident within the restaurant space, where you see for example, the pizza category, they have actually been doing better now versus pre-pandemic. And then you look at the cruise lines, and while cruise lines are unquestionably, arguably, actually one of the most distressed in the entire U.S. economy as a result of this pandemic, we think that the recovery outlook for those, so that's space could actually go beyond 2023, which in our view kind of makes it relatively less actionable in the near term compared to the casinos and hotels that we'll be more or less focusing on today. So again, this heat map is something, gives you our current outlook for various, industries, which again informs how we look at them in the aggregate, and also within the respective, subsectors, the individual stocks involved to various degrees of comparability. Next slide, please. So here is a quick snapshot of the sub-industry constituents by market cap, weights, and on the left side is the hotels, resorts, and cruise lines. On the right side is the casinos and gaming. These are all within the S&P Global Industry Classification. One thing's obvious, that is few companies actually dominate the market cap weights for this. The second observation is that the hotels, resorts, and cruise lines are somewhat disparate, because as I just mentioned, the cruise lines somewhat skews the overall outlook for that, because they're the ones that I think have been facing the steepest challenges and continue to do so in terms of both their operating outlook and the near-term liquidity and solvency. Next slide, please. So here's kind of a snapshot overall equity performance for these sub-industries that we're talking about vis-a-vis the broader market index S&P 500. So you'll see here that all three actually seem to bottom around mid to late March, recovering for the most part gradually thereafter. But it's pretty clear in terms of the recovery that both sub-industries have been lagging the overall market recovery again in the aggregate. Granted that the individual stocks are also performing differently. Next slide, please. And here we're kind of diving again to one of the first sub-industries where we see some prospects. Here is the hotels and resorts, some of the key metrics that we watch. RevPAR would be revenue per available room. And then you've got ADR, which is average daily rate, and the occupancy. So on the left chart, you'll see the bottoming off of all three metrics right around the COVID-19 onset in around April. And they have been actually bouncing off those bottoms and trading sideways. But and while the picture is slightly improved, they're still way below the pre-pandemic levels for these metrics, as you can see. And on the right chart, you'll see hotel occupancy ending last year at really the multi-year lows, again, as a result of the COVID-19 pandemic. I might add that in general, the luxury and upscale hotels have been faring worse than the economy and mid-scale hotels, and that's something that we look at in terms of the names that we cover, the portfolio composition of hotels, and it's pretty clear to us that there are opportunities within this space for some names that we think are well positioned than the rest of them. Next slide, please. This is another kind of view of the more projections and outlook for the recovery in some of these key hotel metrics that we just spoke about. The left chart showing what seems like a V-shaped recovery for RevPAR and occupancy and ADR after a steep bottom in 2020 as a result of the pandemic. And on the right chart, you'll see the hotel supply and demand dynamics, which are looking more favorable for this year and next year after the precipitous decline that we saw. So this is something to keep in mind, as a lot of hotels have been building out their pipelines in U.S. and international markets, and there's always questions about overcapacity expansion. But one of the things that the COVID-19 did is to somewhat rebalance the supply and demand equation, and we think that the pent-up demand is really something that bodes well looking out in the next couple of years, and partly explain the V-shaped recovery on the left chart. Next slide, please. Here we're looking at the resorts, the solvency for this sub-industry, and this is something to keep in mind as you think of the individual stocks in here. So one thing is pretty clear is that there's been some improvement in liquidity as a result of these capital raises a lot of these names have made since COVID-19. Many of these names have tried to shore up their liquidity by suspending stock buybacks and dividends. But as I indicated earlier, the cruise lines actually have the much more precarious situation. So which is why we're kind of still staring off that space. But you see the leverage, indicators, debt equity and EBITDA interest coverage. Those are there's unquestionably been some degradation since the onset of COVID-19, and that's something to keep in mind as you kind of look at individual stocks here, because they're all, for the most part, navigating various degrees of challenge in terms of their near-term liquidity and financial flexibility. Next chart, please. This is one area of vacation rental that's kind of thought about as a growth platform for hotels. More or less a silver lining. This is an area that's dominated by Airbnb, which, as some of you know, just went public. And the numbers here in terms of the addressable market for vacation rentals, also known as alternative accommodations, you'll see the serviceable addressable market and the total addressable market. These numbers are from the Airbnb's S1 filing, and includes short-term, long-term stays and experiences. So even if you assume that the addressable market is only a fraction of what's identified here, I mean, these numbers are questionably, mouth-watering. And my sense is that a lot of hotels have sensed the opportunity and also the potential disruption, which this is costing their business. And as a result of COVID-19, there's been a lot of awareness in terms of this space and the potential for share shifts from the traditional hotel to the alternative accommodation, which is why we see some of the hotels starting to invest in this space to various degrees. I would say that based on these numbers here, we're still barely even scratching the surface, barely into the first inning of what this could mean in terms of the long-term market opportunity. Next slide, please. Here we talk about casinos and gaming in Macau. As some of you know, Macau, which is Chinese territory, is actually the largest market for gaming in the world, far bigger than Las Vegas. And here, a lot of U.S. casinos have significant exposure in Macau. Actually, for the most part, predominant in terms of their operating cash flow. The left chart shows you what has happened to Macau gaming revenues before and after pandemic, and then the right one is the visitor arrivals. So you'll kind of see that the gaming revenues in Macau have leveled off their steep declines, and in the last since last fall, there's been some rays of light. Nevertheless, the trends are still way below their pre-pandemic levels, both in terms of gaming revenues and visitation on the right side. But the good news is that recently the travel restrictions have started to ease in Macau based on the government stipulations, and a lot of the visitation in Macau actually coming from mainland China. And this is something that really influences the performance of the U.S. casinos to a greater degree. And some like Wynn Resorts, as we'll soon find out, actually have a significant portion of their operating cash flow generated from Macau. So this is something we keep an eye very closely, see how those trends there impact the casinos. Next slide, please. And here we're looking at Las Vegas, which is also something that the revenues and the visitation actually have been trending well below pre-pandemic levels. I would say that the trends in Las Vegas are a little bit lag in terms of the recovery, because most casinos there are still operating with extremely limited capacity, mandates. The left chart here shows you Las Vegas Strip gaming revenues, which have still trending way below pre-pandemic levels. On the right chart, you'll also see the visitation trends, again, which are still off, and that's something, again, the outlook for Las Vegas recovery is still very tenuous at this point, and part of the reason for that we'll see in the next chart. Next chart is the visitation, the convention business, right? This is the convention business that's a big driver. It's very pivotal to the outlook for the Las Vegas market. And what this chart shows is this convention attendance completely evaporating since April with the onset of COVID-19 and remains so as we speak. And we don't expect that Las Vegas is going to see any meaningful recovery until the convention business is back, which in turn is highly dependent on the outlook for COVID-19, the widespread availability of COVID-19, vaccine. So, this is definitely something to keep an eye on as we think about the individual exposure of the various casinos that have different levels of convention dependence. Next slide, please. Here, similarly, we're looking at the liquidity and solvency picture for casinos and gaming, vis-a-vis some of the key metrics like cash per share, current ratio, debt equity, and EBITDA interest. And what's pretty clear is that there's been some degradation of some of the financial leverage ratios, even though Liquidity somewhat has benefited from a slew of capital, raises. A lot of these casinos are highly, leveraged, and we do look at their balance sheet. The cash burn is still something that, we keep an eye on. At the peak of COVID-19, some of these casinos were, burning literally hundreds of millions of dollars per month, while the casinos were closed, which is why they had done some aggressive capital raises, and that is starting to ease now that some of these casinos are partially reopening, but something that we definitely keep an eye on. Next slide, please. Here's a margin platform for casinos, online gambling. This is a market that is barely tapped. You see a double-digit CAGR projected growth over the next decade. And we're still in the early innings of online gambling. And the catalyst here has been the legalization of the U.S. sports gambling, a Supreme Court decision in May 2018. Following that decision, a lot of casinos have aggressively moved to invest in this space and trying to grab the low-hanging fruit. And we're seeing joint venture, strategic partnerships, etc., among the casinos. Actually, some of them are starting to generate hundreds of millions of dollars in incremental revenues, as something that the industry perceives to be a long-term, growth opportunities. As we speak here, casino gambling is legal in almost 24 states, and we expect that number to grow potentially over 36 by the end of this year. So it's questionably an emerging opportunity that some of the major casinos are looking to tap into. And next slide, please. And here, I'm going to look at the top stock picks within these hotels and resorts and casinos and gaming within hotels and resorts. Is this Travel and Leisure? This is a company that we think will definitely benefit from the return of leisure travel with a widespread vaccines availability by the second half of this year. The company sees its mission as putting the world on vacation. They just reported earnings yesterday, and we, I think the themes that we saw have been consistent, and we think actually they are leveraged to a very, very, recovery outlook for leisure. And Marriott is another one that we have 4 stars on. It's the largest hotel operator in the world, integrating Starwood. And one of the reasons we like Marriott is the scale that they bring and the valuation, of course, but also the fact that even the CEO passed away, which reported in the news, but I think they have a deep bench of executives that will continue strategy. So that's kind of why we like Marriott. And then on the casinos and gaming, Wynn Resorts, the 5-star. Wynn, arguably of all the major casinos, is the one that's most leveraged to a rebound in Macau, where they get north of 2/3 of their operating cash flow. And we like Wynn for the reasons, the fact that they are now starting to tap into online sports betting through WynnBET, still rolling them out. For the same reason, MGM Resorts, which is a 4-star, and we like MGM for much of the same reasons. Exposure to Macau, they're actually heavily dependent more or less on the convention business, but I think one of their strengths is the regional markets outside of Las Vegas. They've got operating in many, many states where the regional casinos actually recover at a much faster pace than we see in Las Vegas. MGM, they have MGM Bet, which is online sports betting now. I think they're north of 10 states, and they're rolling them out really fast. They're generating this year expect to hit $200 million in incremental online betting revenue. So this is all dropping for the most part a high margin business. So and I think at this point I want to wrap up and turn it over to my colleague Colin, who will do a deep dive into 2 other areas that we consider distress, which is the airlines and commercial aerospace in a segment. Colin?
All right, thanks a lot, Tuna, for the coverage of those industries. Now we're going to jump into 2 others that are related, airlines and commercial aerospace, which are obviously involved in getting people to hotels and casinos. So a quick snapshot here of the U.S. airline industry. Market cap as of mid-February was down 16% versus the start of 2020. So completely missed that strong rally we saw for the broader market over the last year. But it is starting to come back. If you've noticed, airlines are really starting to move up in the last month or so. So as vaccines come out, people are getting a little more optimistic. Next slide, please. But let's talk about what happened in 2020 to this industry. So leading up to the pandemic, we saw pretty steady demand growth for air travel. Revenue passenger miles, that's how the industry measures its volume, and that's one passenger traveling 1 mile. So it really started to ramp up towards the end of the decade. We were at 4% and 5% growth rates, but then the pandemic hit, lockdowns came, and we fell 64% in 2020. Next slide, please. So just a little more detail on the downturn. March, April, and May were the extreme lows. That's when lockdowns were at their peak. And passengers have been coming back over the last 10 months or so as economies have reopened to some extent, but we're still at less than half of pre-pandemic volume, still down roughly 60%, which has just been devastating for the industry. Next slide, please. So the way that airlines have responded to less passenger demand is to drastically reduce their flight schedules. So the capacity for the airline industry is measured in available seat miles. And so that's one seat, whether it has a passenger in it or not, traveling 1 mile. So for US domestic airlines, available seat miles are at the end of 2020, we're still down around 40%, and international's down 62%, even worse as the restrictions on international travel are even greater than domestic, and that's still the case into February of this year. Next slide, please. So the financial impact has been tremendous in a bad way. So with revenue down 62%, airlines have a huge amount of fixed costs for their fleets and their gates, and also for a very large, it's an employee-intensive business. So free cash flow for the industry was strong in 2019 at 11 billion, fell to 28 billion negative in 2020. And that actually, that includes payroll grants of around 16 billion that the airlines received from the federal government. So without that government support, you would have seen north of 40 billion of cash burn across this industry. So very dire conditions, obviously. Next slide, please. Can we jump to next slide, please? Okay, thank you. So we can see, looking here, the balance sheets have really deteriorated as airlines have responded to the pandemic. So the key metrics to look at are total debt has grown by 59% in 2020. That's up 54 billion across the industry. And it's not just been new debt that the airlines have taken out to plug the cash burn. They've also issued a lot of new equity. So the share count's up 13% on average, but some really heavy dilution has occurred for certain airlines, notably American. Their share count is up 45% since 2019, and Spirit Airlines as well, a similar mid-40s number. Next slide, please. So now let's talk about the opportunity, because after that lead-in of how dire things have been for the airlines, you may be wondering why we see any opportunity here. So the key question becomes, are these companies going to recover the profits they were seeing before the pandemic? So do you believe, you have to figure out if you believe a full recovery can happen, and you also have to think about when. So let's just give you an idea of what the stock returns might look like. Let's say it takes 7 years for American Airlines to recover its pre-pandemic stock high. That would be on the far right of this table here. If it were able to do that by 2028, you'd get an 18% annualized return roughly, and that was when it was trading at 18. So that's on the higher side. They're a highly leveraged airline, but let's take a look at one like United. Not as highly leveraged, much better profit metrics prior to the pandemic. If they're able to recover in 5 years, you'd see a 16% annualized return. So this is what catches our interest. If the recovery does happen, even if it takes 5 years, 7 years, there's some really nice returns hidden in the airline space. So let's go to the next slide, please. Because we want to talk about that question of, is the recovery going to happen? So in our view, we think that passenger counts in the US can fully recover in 2023 or even sooner. And that ties back to that disposable income that's elevated, the vaccinations really releasing pent-up demand, and all these things that we think the pandemic hasn't fundamentally changed. And it's important to note that our view there is contrasting with the popular media narrative. And we've got a headline here from the Wall Street Journal just back in December, opining that the pandemic could cut business travel by 36%. So that's an interesting question, and one we've had to really grapple with. Is the pandemic fundamentally changing business travel habits? So we tried to look at some data to figure that out. And what we're showing here on the chart is these are private jet flights, only domestic flights for the US. So we can see how these have trended from January 2020 throughout the year of the pandemic. So obviously hit a steep bottom in April, but then you'll notice by October, which is when the summer wave had ended and it looked like the COVID cases had stabilized, private jet flights were actually higher in October than January. So that caught our eye because that seemed to indicate who's taking private jet flights. Well, it's mostly businesses. So they are eager to travel. So that caught our eye. Let's go to the next slide and show you some more data. We also noticed that in China, also in October, COVID cases were, based on their reported data, were barely a trickle. And at that point, domestic passenger kilometers in China had made essentially a full recovery. So they were just 1% below the pre-pandemic level. So that's another thing that, if you think about that in the context of this popular narrative that, businesses are no longer going to travel like they used to because of the virtual meeting technologies they've used during the pandemic, the private jet data and the data in China, where it's kind of the only major economy where COVID had slowed to a trickle, we think that totally refutes the narrative that businesses aren't going to be traveling as much. Because as soon as COVID kind of got under control in the US, business jet flights were back above the January level. And in China, there was a full recovery in domestic travel when the country's COVID cases had gone to zero, basically. Next slide, please. So I kind of got ahead of myself, but that is our takeaway. Businesses and consumers are very eager to travel when COVID-19 becomes a minimal threat. And we've seen that already play out last October. And now that this winter wave seems to be winding down and vaccinations are ramping up, we see a very high likelihood that travel comes back in full by 2023. And next slide, please. So that leads us to, that's kind of our case for the full recovery in demand, but we have to be careful about which airlines we target for buy recommendations. We have to make sure that that major debt increase that the industry saw in general doesn't become debilitating. So here we're just showing net debt to 2019 operating earnings, which is more of a normal year for airlines, obviously. We want to make sure that that leverage number is still 5 or less, just to make sure, we think in the case of someone like an American, a 9 times is just too much for them to ever get back to, peak earnings level. Next slide, please. Next slide, please. Oh, thank you. So another thing we have to look at, in addition to debt, is the airline industry has long-term purchase commitments that extend out usually over the better part of a decade. So we have to be careful to look at these as well as the debt, because these are a debt-like obligation that can really be a big drain on cash flow. So just to give you an example of one we'd want to stay away from, on the bottom of the table, Spirit Airlines, we've highlighted it in 2022 through 2024, the commitments to purchase new planes are well in excess of the operating cash flow they generated even before the pandemic. So even if you get a full recovery in demand, when you're having to spend that much on new planes, we just think it's too risky to go into airlines with that type of commitment schedule. Whereas a Delta is much more manageable. Commitments tend to be less than 30% over the next few years of operating cash flow. Next slide, please. So in addition to airlines, we like their suppliers, the companies that make the planes, Boeing and Airbus, as well as hundreds of companies that are in the supply chain. We don't like all of them, but we do see this as a distressed industry. It's actually been down even sharper than airlines, down about 25% since the start of 2020. But we'll talk about on the next few slides why we think there are opportunities here as well. Next slide, please. So just a quick snapshot, measuring 2018 revenue as sort of the pre-pandemic peak, because that was prior to a separate crisis, the 737 MAX grounding. We can see from the peak in 2018, revenue for this industry is down 37%. So a huge downturn, unprecedented, similar to airlines. Next slide, please. And what the response has been is basically to cut production, because airlines are no longer taking deliveries of their aircraft. They're finding ways to push out those commitments they made. Generally, the purchase commitments can't be erased, but they can be pushed into later years, generally with some cash penalty associated with that. But you can look here on the left chart. Airbus's aircraft deliveries fell 80% year over year in April, and they only recovered to about down 32% in January of this year, so still down sharply. And what that means is these manufacturers are accumulating inventory, so they've been looking to cut production until demand returns. So for wide-body planes that are more associated with international travel, you've seen cuts of up to 2/3. Let's look at Boeing 787, for example. And on the narrow bodies, which are more common for domestic flights, where demand is a little bit stronger, the cuts have been more like 30%. And an example there is the Airbus A320. Next slide, please. So just a quick highlight here, the cash flow for the industry, negative 27 billion, an unprecedented year, obviously. Similar to airlines, but without that 16 billion in grants from the government. Next slide, please. So now we'll jump into the opportunities, and we've got a similar chart here showing what the prospective annualized returns would be for some of these companies in commercial aerospace if they simply are able to recover their pre-pandemic peak. And one to note here is, let's say it takes 7 years for Boeing to get back to its previous high of 441. You'd be seeing a pretty nice annualized gain of 11%. So that's pretty attractive to us, because we don't think it's going to take anywhere near 7 years. We think the 3 to 5 year timeline is much more likely, and that would put your returns ranging from 15 to 27% annually. So the reason we're confident in the recovery for commercial aerospace earnings is a lot of the same reasons as we think airlines will make a full recovery. We just don't buy into the narrative that business travel is down for good. We think businesses mostly were already using virtual meetings before the pandemic for things where the face-to-face interaction was not of high value, but there's still plenty of instances throughout the business world where you just can't replace face-to-face interaction. And we think that's why we saw those recoveries in private jet flights in October, as well as in the China domestic flights, because businesses do want to travel even with the great technology tools we have today. Next slide, please. So a similar story here to airlines. You've had a pretty big debt increase across the industry for the most part, but balance sheets here have tended to hold up much better. So we're still looking for commercial aerospace firms with leverage below 5 times, and that puts pretty much all of them on the table as potential investments to us. Next slide, please. So another thing to keep in mind here is the balance sheets are not in dire conditions, but in our opinion. But we also are talking about an industry that's seeing pretty strong secular growth and probably will continue to do that over the long term. So it was a banner year in 2018, 8% growth in commercial aircraft deliveries for Boeing and Airbus. And that was kind of rounding out a great stretch of close to 7% annualized growth from 2011 to 2018. So what was happening is, particularly, you got massive populations in underdeveloped economies. And as they become developed, they require much more air travel. And this was causing demand for airplanes in places like China and Brazil and Africa to grow at significantly higher rates than in the US. So we have to keep in mind that the commercial aerospace industry is a much more global customer base than the US airline industry. So this is a very strong growth industry before the pandemic, and we think it will be once the pandemic is over. So we really do like the growth opportunity here. Next slide, please. Another reason to be excited about commercial aerospace in our view, and this is something that the airline industry lacks, is years and years worth of backlogged orders. So we saw that airlines have to contract their purchases out years to get in line because there's so many global airlines buying planes from so few manufacturers. So the backlog at Boeing is about 6 years when measured at peak annual delivery rates, with roughly 5,000 planes in the backlog. And it's even higher at Airbus, roughly 7,200 planes, which is 8 years worth of deliveries once we get back to a normal year. So we love that as sort of a downside risk limitation, that they have this great backlog to work down, even if new orders aren't coming in. But the great news is we think new orders are starting to come in. So even for the beleaguered 737 MAX, since it was recertified in November, we've seen Ryanair put in a major purchase of 75, Alaska Air 50, and Virgin Australia 25. So if you liked the general idea of the commercial aerospace recovery, but we're maybe nervous that the 737 MAX isn't going to be competitive, we think that that risk is starting to fade away as the plane is flying again. Southwest is flying, and American's flying it across the US as we speak. We think it'll be flying again in China in a few more months, and the orders are starting to come back as the airlines recoup the great fuel efficiency that aircraft provides. Next slide, please. We can skip this slide and just go to the stock picks, please. We'll just round it out here. So that covers the airlines and their suppliers in the commercial aerospace industry. The takeaway is we think as COVID recedes, vaccinations ramp up, we don't see any major change to the demand picture for either of these industries. So we like certain players here where there's still healthy balance sheets, or at least manageable debt levels. And we have 4 picks in the airlines where we're pretty positive on airlines in general. 4 buy ratings there, 4 stars. We like some of the commercial aerospace smaller suppliers like Hexcel and Spirit even more, because those are much healthier balance sheets in our view, and they're also diversified into defense and some industrial supply as well. So those, we think in certain instances, some commercial companies have been sort of the baby that got thrown out with the bathwater, where the market seems to think they are purely supplying aircraft, but in a lot of cases they have a bit more diversification. So with that, we'd love to take some questions on any of these distressed industries and the great opportunities we're seeing in them.
Thanks, Colin and Ken. If you do have questions, please send them our way in the chat box. We did get a few. Colin, just staying with you on airlines, as you look out to 2021 and 22, can you give us your insights about trend for pricing and also fuel costs?
That's a very good question, because what can happen is the passenger counts can fully recover, but if pricing is still down, in the 15 to 20% decline that it's currently at, the revenues are still going to be down pretty sharply. So we think that there's going to be a lag where we think passenger counts are going to make a full recovery probably sometime in 2022, but we think it'll probably be closer to middle of 2023 where you get that full revenue recovery and the pricing gets back to where it was. Because one issue there is that the global fleet is continuing to grow. So the same number of passengers in 2019 is now not going to fill as many planes as it's going to fill less planes relative to global capacity now when we're out in 2022 and 2023. So we need to see a little bit of more time for pricing to fully recover. Oh, and then on the fuel question, we do think, the sort of work from home trend, we see that really taking a lot of gasoline demand out of developed economies, which is, in our view, going to be very helpful for airline margins because they are using an oil-derived fuel, kerosene, and we think over the long term prices for that are going to be secularly down based on lower commuter consumption and also just a tightening of more electric vehicles and kind of a tightening of regulation on global oil demand.
Great. Two questions on casinos, Las Vegas. A pretty bearish chart there on convention activity and how critical is convention activity to the success of Las Vegas casinos. How badly do they need them?
I would say it's extremely critical, Ken, and so critical that I'd say that the fall off in visitation, the overall visitation to Las Vegas, is extremely highly correlated to the fall off that we've seen in the convention business. Convention is also something that beyond just filling up the hotel rooms, they're also a very big driver of some of the underlying casino metrics. No surprise, people who attend convention also go into the casinos and whatnot. And that's why I think, Ken, Las Vegas has actually been trailing some of the regional markets. I mentioned MGM, which is much more exposed to the regional markets that rely on day visitors versus convention business, where I think the air travel has been significantly affected. You saw on the charts that Colin put up in terms of the passenger screenings, air travel, which is still way below pre-pandemic levels. So not until there is more visibility on vaccines development and widespread distribution, not until then do we expect that the convention business has any meaningful signs of recovery. So at this point, it's still fingers crossed and just kind of trying to read the trends and the overall tea leaves here.
We're coming up at the hour, so this is a question for each of you, and it came whether most of these stocks have made a huge move already. Perhaps maybe we go back to the lows of last October. So for each of you, if you could address whether you see any particular stock or sub-industry where you feel that there's still outsized opportunity over the next few years.
Yeah, I mean, I can go first on that. I think one of the things that's pretty clear to us is that all the sub-industries have experienced different degrees of performance coming out of the COVID-19. And even within specific sub-industries, different stocks have somewhat reacted differently, depending on their portfolio composition, exposure, and things of that nature. So, more specifically, stocks that we highlighted are those, I think, relative to The rest of them, I think, still are leveraged to, we think, the upside, either, for example, the new opportunities that we talked about, online sports betting, which is why we highlighted Wynn and MGM, or the emerging opportunity in alternative accommodations. For example, Marriott has now, they're kind of been dipping into luxury alternative accommodations within select markets, which is kind of part of why we like that. But I think, and more specifically, I think we would still steer away from those that are relying on live outdoor events, even though the stocks there, Live Nation and have been coming back strong. But the cruise lines, you'll see a lot of volatility, and arguably, I think one thing is clear, that when there's indications of vaccine availability, I think it's going to be a case of rising tide, lift all boats. What we've done is to position our picks right now to kind of anticipate that recovery. Because by the time it actually happens, the vaccines come out, it's going to be probably too late to get in on these names. But balance sheet, liquidity, solvency, things to keep in mind. And that's why, even though some names look good on paper, we're still a little wary of some of the potential liquidity and solvency constraints.
Great. Colin?
I love the question, because we have seen certain airlines now where market caps are now above the pre-pandemic level. So the valuations are definitely running up, and we think some of them aren't deserving of that, but some are. But we think it's a much better risk-adjusted return right now in some of the smaller suppliers to the commercial aircraft supply chain. And so we would note, you still got some companies like Spirit Aerosystems and Hexel. These are suppliers to Boeing and Airbus, and down roughly 50 to 40% from the pre-pandemic highs. And so that's such a sharp decline even versus airlines. So there's still there's much more better valuation protection here in our view. And we think, even if, like we said, we love the risk adjusted return, because even if it takes 7-9 years to recover, you're still seeing probably a market beating annualized return in a company like Spirit Aerosystems. And we're actually very optimistic that the recovery could be more like a 3-year time frame. So in that case, the returns would be tremendous. So that would be one we really like, and we have a 5-star rating on it.
I want to thank Tuna and Colin for a really interesting presentation on tough subject, distressed industries, and also thank everyone for participating on today's call. If we could move to the next slide, please. We have another fascinating upcoming webinar on March 11th, Renewable Energy, Green Shoots for Green Revolution. So much of the mind share in the markets is on ESG, and we're definitely going to tackle this topic. We hope you can join us for that. Certainly you can see where to register. Additionally, for the industries addressed today, you can go to MarketScope Advisor to industry surveys and see the great in-depth quality work that is done, not only for aerospace and defense, airlines, hotels, gaming, and leisure, but other industry surveys that we do covering 68 industries. So thank you today for joining us, and we'll speak to you soon.